Hello friends, welcome back. In the previous video, we saw that the covered call with future requires less capital, but it has the unlimited downside risk if the downside is not managed or protected. I am really excited to share a new covered call strategy wherein you still require less capital and the downside risk is fixed. That is the poor man's covered call with the LEAPS. In this video, I am going to explain in detail about the poor man's covered call, what are the LEAPS, their benefits and the risks associated with the LEAPS. Taking Nifty as an instrument, I will explain the live example, this time with all the adjustments. We will also compare the poor man's covered call with the standard covered call strategy. To get a good idea of this strategy, I recommend not to skip the video, watch it till the end. If you are new to the covered call strategy, there are videos for different types of covered calls. The links are given in the description below for you to watch. As I mentioned, poor man covered call uses LEAPS as the underlying asset. LEAPS are nothing but long-term equity anticipation securities. These are nothing but long-term option contracts. In India, LEAPS or the long-term option contracts are available only for indices. They are not available for the stocks. For indices such as Nifty and Bank Nifty, long-term option contracts are available for more than 1 year. In fact, for Nifty, the long-term option contracts or the LEAPS are available up to 4 years. For stocks, they are allowed for only 1 quarter, but the liquidity is the biggest issue even for the next month options. In the US, the LEAPS are quite popular instruments. Let us now go and check the option chain to understand these contracts a little bit more. Here is the option chain that I have opened in the NSE website, and the Nifty is the instrument that is selected. Let us see what are the expiries available. So if you see here, we are in the third week of May 2022 and we have all the weekly expiry available up to July. And the next quarter monthly expiry, that is 29th September 2022 is also available. And we have December 2022. So like that we have the expiries up to 31st December 2026. That is almost current year plus 4 more years for the Nifty. If you look at the Bank Nifty, we have the weekly expiries like Nifty up to July and the monthly expiry for September, December and the following quarterly expiry. Okay. If you look at any of the stock, let me take Reliance. Reliance, we have the current month plus 2 more months expiries that are available. Let us now quickly look at the open interest of various expiries. For Nifty, 29th December 2022, we have good open interest. You can see the OI here on the last column. There are a number of contracts on the call side as well as the put side. I think it's a good open interest for the December month. Now let me take December of next year, that is 2023. So here the open interest, if you look at, not much. The OI is hardly few, not even hundreds contracts for the call and few hundreds for the put. Okay. So as you go forward, the open interest reduces. Let us now look at the Bank Nifty open interest. I am taking the December 2022. Hardly there is any open interest. So 19 and all. So this is not a good open interest for December 2022 Bank Nifty. If you go to the next quarter, that is 30th March, there is no open interest at all. We can also check the open interest for the stocks as well. If you take Reliance, the current month, June 2022, there is a good amount of open interest. And if you go to the next month, the open interest keeps reducing. For the stocks, open interest, some of the stocks will have less open interest, and especially for the next month, there will not be any open interest. So it all depends on the stock to stock. Here are the benefits of the LEAPS or the long-term option contracts. If you buy the long-term deep ITM call option, they would appreciate similar to the stock would appreciate. If the stock goes up by X points, the call option would also go up by more or less X points. This is one of the cheaper way to mimic or own the stocks. The capital required to buy these long-term call option is much cheaper compared to the buying the one lot of stocks itself. And the risk is limited to the premium that you have paid to buy the call option. Another important benefit of this long-term call option is the time decay is slow. The far call options that you buy, slower the time decay. Of course, you will have to pay more premium to buy the far contract call options. Coming to the risks associated with the LEAPS, LEAPS needs to be managed because they do have the expiration period versus owning the stocks in your portfolio which doesn't have the expiration period. An important thing to be noted with respect to LEAPS is that apart from having the intrinsic value, they also have the time value. We need to manage this time value as well. Because LEAPS are the far expiration period contracts, there will be lower liquidity. Because of this lower liquidity, there will be an impact cost, which is nothing but the difference between the bid and ask price. Normally, the bid and ask price will be slightly more. What is the poor man's covered call? It is nothing but you buy a deep in the money call option of far expiry and sell a call option at the money or slightly out of the money strike in the near expiry. It is near month expiry. The long call here replaces the asset requirement of the standard covered call. The capital required to buy the long call is quite lesser than the buying the asset. That is why the strategy is called as the poor man's covered call. It is also a diagonal calendar spread and it is a debit spread. Why it is diagonal calendar spread? Because the two strikes are at different expiration period and at different strike prices. It is a debit spread because net the premium will be paid and the capital required is the premium that is paid to buy the call minus the premium that is received from the sold call option. That is the net capital that is required. It is always better to pay a less capital than the spread. For example, if your spread, that is the distance between the long call option and the short call option is, assume if it is 600, it is always better to pay 600 or lesser than 600 as a premium. That is because even if the market goes up and expires above the short call option, the chances of you making a profit is high. How do we do the poor man's covered call with Nifty or Bank Nifty, considering all the aspects of long-term options such as their benefits and their risks? We will use the Sensibull option tool quickly to see how to create a poor man's covered call. This will give a better idea. Let me create a poor man's covered call in Nifty using the December 2022 long call option. Nifty is running at 15,782, which is approximately 15,800, and we are in the mid of May 2022. So let me select the December option chain and I will select the in the money call option by going 300 points down. So that will be 15,500 strike. So I'm going to buy this option 15,500 strike, which is running at 1272. The total premium that needs to be paid is 63,600. So now let me go and select the near month short call option. So there is no point in selecting the May month expiry short call option because the premium would have already decayed because we are in the mid of May. So let me select June monthly expiry option chain and then sell out of the money call option. So I am selecting the 16,000 strike, which is running at 377 and sold the call option. So let me press the done button and see here the total premium that needs to be paid is 44,750 rupees. So what is the spread? 500 spread. So if you calculate the premium that we are paying for this spread is how much? So let me calculate using a calculator. 1272 minus 377, which is 895. Approximately double the spread is what we are paying. This is not a good situation for us. So what we need to do is we can go down and select the long call option. Instead of December, we can select the September. So let us see. I will delete this December expiry long option and try to select the September quarterly long option. So unfortunately, we do not have the 15,500 strike open interest in the month of September expiry. So what we'll do is we will go down and select the July month expiry. So you see here the July month expiry, we have the 15,500 open interest, which is running at 751. So let me buy this call option at 751 premium, press on the done button. So now what is the net debit or the net amount that needs to be paid is 18,700. So what is the spread? Spread is still the 500. And what is the premium that we are paying? Let me bring the calculator again. Okay, so let us calculate the premium paid, that is 751 minus 377. So we are paying 374 rupees for the spread of 500, which is a good situation. So in fact, we can consider this position to be taken. Friends, as I mentioned, this is a calendar diagonal spread and the max loss is what the premium that you pay. In this case, the max loss that you will lose is 18,700 if market goes and expires below 15,500. And the max profit cannot be calculated because this is a calendar spread. It is difficult to predict the option premiums as the market will be volatile in coming days. Here is the payoff graph. Friends, any of the calendar spread payoff graphs will always be indicative payoff graphs because it is very difficult to predict the break-even points and the max profit for the calendar spreads as the strikes are in different expiry period. The premiums will be behaving based on the volatility change that is coming in the coming days. So that is why all the calendar spread payoff graphs are only indicative payoff graphs. So what is important from this is that we know the spread and how much we are paying and how much is the max loss. And of course, if market goes upwards, you will be making a profit if you have chosen the right spread. Friends, to make it easy for you to understand the adjustments of poor man covered call, I prefer to use a diagram like this instead of using the calendar spread payoff graph. I have created a poor man's covered call position here for the purpose of illustration. When Nifty was at 16,300 in the beginning of month May 2022, a one lot of July month Nifty call option at strike 16,000 is bought at the price of 800. This is a long call is what is bought in the month of July, and one lot of Nifty June month at the strike price 16,600 is sold at the price of 300. So we gave 800 as the premium for the July month long call option and we collected 300 rupees as a premium from the June month short call option. So the spread between these two long and short call option is 16,600 minus 16,000 is 600, and the premium, the net premium paid is 800 minus 300, that is 500. The max loss in this case is the net premium paid into one lot, that comes out to be 25,000 rupees. In fact, we are in a good position because we have paid less premium than the spread. The spread is 600, but we paid 500 rupees as the premium. So as I mentioned, the first goal is to collect the premium paid. If the market goes against us, we will exit at least in the no loss, no profit zone. And as I mentioned, the max profit and break-even points cannot be calculated because they are the calendar spreads. So let us now look at the adjustments one by one. In the first case, when the Nifty goes and expires above the short call option. In this case, let us assume that the Nifty goes and expires at 17,000 for the June expiry. The sold call option, the June call option at 16,600 will be in the money by 400 rupees. But you have already collected the 300 rupees. So this sold call option will show minus 100 as the negative MTM. But the long call option of July would have appreciated similar to the appreciation in the Nifty. So the net position probably will be in profit, and we can consider this position to be closed and book the profit. So therefore, this case of when Nifty goes and expires above the short call option, we may not need to do any adjustments. The next case is when Nifty starts falling and it goes and expires below the long call option. In this case, the position will be in negative MTM because the long call option would have lost more value than the short call option. Because the view went against us, our goal should be here to collect the premium that is paid, that is 500 rupees, and come out of the trade at least no profit, no loss zone. What we can do is we can shift the June month short call option step by step to collect the premium. We can do this until July expiry, that is the long call option expiry, to collect the premium of 500 rupees to get the trade at break-even. This is how we can adjust the position when Nifty starts falling. Friends, another very important point to be noted here is a big gap down and a continuous bearish market will put you in trouble. Meaning it may not even give you a chance to shift the short call option step by step. So therefore, it is very important to know the position size and also the max loss that you can take for such trades. The third and the last case is when Nifty expires between a long call option and the short June call option. Let us say Nifty expires for the month of June between 16,000 and 16,600. In this case, the June short call option will expire worthless, it stays out of the money, and you can keep the 300 premium that you have collected as a profit. Now out of 500 spread, you have already collected the 300 rupees as the premium. The next step is you have to go 1 or 2 steps above and sell a short call option for the month of July here. See here, I have sold a July call option of 16,700 or 800 and collected the premium of 200. So the net premium that you have collected is 300 from the June and 200 from the July. So which is a break-even point we have already hit. Even if the Nifty goes below the long call option. Now, in fact, if Nifty goes and expires above the July short call option, you would definitely make a money out of this position. So this is how we have to handle when Nifty expires between long and short call option. Here is the quick comparison of the standard covered call and the poor man's covered call. For both these option strategies, the market view that we require is the neutral to bullish. The capital that is required for the standard covered call is equal to the 1 lot equivalent of the stock or ETFs, which comes out to 5 to 10 lakhs. Whereas the capital required for the poor man's covered call is substantially less, which is equal to the premium that you pay to the debit spread. The downside risk for the standard covered call is substantial, but you have an option to keep the asset or the stocks as long as you want, expecting that there will be a recovery. The downside risk for the poor man's covered call is the premium that you have paid for the debit spread. The maximum profit in case of standard covered call is the premium that you receive by selling the call option, which is a guaranteed return from the standard covered call. In case of poor man's covered call, the max profit cannot be estimated as I explained because it is a calendar spread and it is a debit spread. The adjustments in case of standard covered call may not be required, but one can still do the adjustment and try to get more premium. That is possible. In case of poor man's covered call, because you have already paid the premium, there could be a need to do the adjustment to collect the premium paid at least. Friends, a very quick summary or the conclusion of the poor man's covered. This strategy requires a market view which is neutral to bullish. This strategy is diagonal calendar debit spread. You are paying the premium. The max loss is known, which is equal to the premium that you have paid. When the market view goes wrong, our goal is to collect the premium paid so that we can exit with at least no profit, no loss zone. This strategy is possible to do with Nifty and Bank Nifty. And this strategy may require adjustments and definitely it requires a monitoring. That's it for the Foreman's covered call. Friends, there are other covered call videos, the covered call with stocks, covered call with indices, covered call with future. Do watch those videos and pick the ones that suits you the most. I hope you learned something out of this video. Do consider pressing the like button and subscribing to this channel if you have not yet. If you have any feedback, comments or clarification, use the comment section below. Thank you for watching. I will be back with another video soon.